Hello, everyone, and welcome to another week of Market Insights. We have narratives going across every direction, some pro US, some market economy is going well, others are dooming everything, AI is somehow involved, and now we have to look at the dollar. Who can make sense of all of this other than our wonderful host, Chris Belchamber of investment management fame? Here I am, Daniel, just trying to make sense of all of this and what the crazy market has been up to. How's it going? How are things in the markets? Is everything going to be fine, or are we all doomed? Where are we?
Everything will be fine. But we have a lot to go through. We just nobody knows all the answers. We have to take it step by step and day by day. But certainly a very eventful week, and I think it was really a lot keyed off the intervention and the fact that the policy narrative is kind of breaking down. And you can see that in a lot of the asset moves we've seen, and people really need to think about their allocations because I think most people are not really seeing what's going on. You can't take the policymakers and what they're saying completely on trust. They have to say what they need to say. But certainly in the Twitterverse, people are picking holes, big holes in what the policymakers would like us to believe.
All right. Well, speaking of Twitterverse, that is where we are headed now, as per usual, where you have curated a breadcrumb trail of hints about what is going on, and hopefully you can help us decipher them. Again, for everyone, this is at Chris CBIM on Twitter, X, whatever you want to call it these days. And the top post you have is a spicy one. And so let me read this and then ask you why you posted it. So here it is. Rome debased its currency to pay the army and preserve the frontiers. Spain consumed the wealth of the New World, financing wars across Europe. Britain emerged from two World War victories, but financially exhausted, and then had to surrender its position at the center of the global economy to the United States. Military power is always dependent upon economic power, yet the warmongers imagine the relationship works in reverse. So, what inspired you to post this?
Well, I think that people have got to rethink the dollar, and I think it's going to take time. I mean, the dollar's not going to end tomorrow or really anytime soon, but the way it behaves internationally is changing and changing quite quickly, as we'll show. And this week, we had a breakdown in the dollar because it was really triggered by intervention from the US Treasury. I'm going to talk quite a lot about that. And basically, the market isn't buying the effectiveness of what they're doing and what they're trying to do. And so the dollar went down. But we'll get into more of the details as we go along.
Fair enough. And I see this seems to be a fairly significant event where the dollar's dropping. How does measuring versus the moving average inform us about the dollar's strength?
It's an indicator of strength. You can see that we haven't been there for 4 months below that. So the trend it went up from I think it was March or April, and now we've completely broken that down. But I think some other charts will show us some more insightful statistics.
All right. Well, I'll keep scrolling, and you tell me what you want to talk about first.
Okay. This yeah, if you read that paragraph, because
Sure.
it shows how incredibly unallocated US investors are to precious metals. I mean, it's really quite astonishing.
Right. Okay. So we have a lot of developments occurring at a time when ownership of gold in Western capitalist market is abysmally low. So everyone's selling gold except for the central banks and China. And then we have physical ETFs representing about 0.3 of the 100 trillion estimated value of North American portfolios. Okay, so no one's interested in physical, tangible things in the West. Gold mines represent a further $700 billion, taking total sector exposure to about 1%. To correct this underrepresentation requires a purchase of the equivalent of 6,750 tons of gold for every 1% increase in portfolio exposure at current prices. That's 2 years worth of global mine supply. So help me understand that in simple terms. If I'm a sixth grader, what does this mean to me?
Well, there's another chart, and I'm not sure I'm showing it today, but people used to have up to 50% allocation to gold, and now they have a 1%. And just to increase from 1% to 2% means they have to gobble up 2 years of global gold mine supply.
Okay.
So the tightness of supply demand plus the inadequate allocation in an environment of a weak dollar is astonishing.
Okay. So this is we're committed to this course of not trusting gold, and even if we did want to reverse course, it would be difficult now.
What, as investors?
Well, I guess as investors, but even if you are trading for more buying gold, uh, you're buying existing gold, not stuff that's freshly mined, right?
Well, yeah, yes, and so the disparity is quite enormous, and let's just reflect on the idea that the S&P 500 peaked against gold in 2000, 26 years ago. So this is an outperforming asset relative to the S&P 500, which everybody loves.
Yeah.
So just think about that. I mean, it's an astonishing bias amongst American investors.
Yeah, it seems pretty remarkable.
Right, and you can see that it's in a long-term bull market, as you can see there. That's silver actually,
Yeah,
but it's very similar to gold. And you can see that of the events of this week, we're now bouncing again. That may have been a correction, and now it's going up again like a rocket.
Gotcha. Okay, and this is you following on buy gold, not stocks, and so this is.
Is this? Are you on the reposts? Are you on the reposts?
No. Do you want me to switch to reposts?
Yes. Always go to the reposts. Yeah.
Okay. So this was the.
Yeah.
Did you want to talk about this one as well?
Well, no. Let's skip that.
Okay.
It was really something to mention. Okay. So
this is the one with U.S. Treasuries that you were talking about earlier.
Well, one of them, yeah. So, I mean, what you're seeing is foreign official holdings of U.S. Treasuries in Fed custody. So you can see that in the last 2 years, that's been going straight down, and particularly this year. So that's just a quick one. Let's keep going, just to make that point. But now this, I think. To talk about this intervention, I thought it's very hard for people to manage what big numbers. Could you give that title again?
Sure. Yeah. Besson's
So
buying back
Besson,
$4 billion of 40 trillion US debt
yeah,
visualized. That
so
is pretty
that's
funny.
right. So you got like 4 zeros there,
Yeah.
order of magnitude. And so here we have someone on Twitter saying, good luck with the 4 billion. You've got, another 40 trillion to go. It's just the futility.
Yeah.
And we'll see how the market reacted. But I thought just that picture maybe brings it home how people reacted to Bessent's move last week and say, well, so what? I
Yeah.
mean, 4 billion is a lot of money to me,
Yeah.
but
You're not going to
relative,
fill that hole.
yeah.
Yeah. I
But
understand.
just to make a visceral, and here's another way of looking at the dollar. I mean, the dollar weakened relative to emerging markets below the lows of March. So if the dollar is weaker than emerging markets, that shows how weak it's getting.
Well,
There are many ways that you can look at the dollar, but when it's weaker than emerging markets, then that's telling you something.
is that because emergent markets you would expect to be very volatile and so wouldn't be as.
Historically, emerging markets have done very poorly. The dollar has been strong, and you can see it against G10. It's weakened very substantially, not just this week, but really for the last couple of months. But it's been even weaker since this whole year relative to emerging markets. And I guess that a lot of that may well be because the Chinese yuan has actually been quite strong.
Gotcha. Okay. And then we
Just
got
to make that
Besson.
point.
Yeah.
Yeah, so this
No.
is the actual intervention. On the 30-year yield, you can see that it collapsed, 10 basis points or so when they announced the plans to double the buyback. But ever since then, it's just come back more or less to where it was before. Now, it may well be that the Treasury is going to be sufficiently happy to have a threat of intervention, and maybe their objective is to slow the pace of decline in Treasuries. So if that's the case, you can see why he might want to do it. But as a long-term vehicle for changing the trend of Treasuries, it's futile. So that's the distinction to make. So the market did react and say, what's going on here? And then they thought, oh, well, no big deal.
Right. So it sounds like maybe this will have a big impact when it was first tried. And then everyone's like, okay, well, this changes nothing for real. And so now that you've said it again, well, we already know it doesn't really change anything. Is that the
Maybe it changes short-term tactics. In terms of long-term outcome, it's immaterial.
That seems to be a common theme here. Lots of short-term impacts that have no long-term effects.
Right. And we'll get to more of that. Yeah. Not just in this area. This was, when Walmart falls 9% in a day, it's telling you it's a macro indicator that we're seeing all kinds of stress at the low end, and in some cases worse than prior to 2008.
Right, especially because Walmart probably ships a ton of things overseas as well. So you're not just getting a U.S. bubble; you're interacting with the world's energy supplies.
Yeah, I mean, Walmart is just huge, and if Walmart's struggling to make a profit, get good demand, then it's an indicator. So it was a bit of a shock for the market this week. I thought it was worth.
Yeah, how often does it drop this much in a day? Like when's the last time?
Very, very, very rarely. And that point is worth noticing. Just below it says basically 60-day delinquencies on subprime auto loans has risen to 6.7%, which is worse than the worst months of 2008 financial crisis. So there's
Yikes.
stress in the you know, low middle to lower class,
Yeah.
at least.
Okay.
Now this is dollar down, and we already showed it's the silver and gold are strongly responding. But look at this. Here's a major a chart pattern here in the Bloomberg Commodity Index. This is across all commodities. And you can see that it looked like it was going to break out, and they've basically managed to suppress oil prices in particular, and trying to suppress commodities. But you can see this week commodities went up above that breakout line again. So
Yeah,
this is huge. So it's not just gold and silver; it's right across the commodity complex, which is another aspect of a weak dollar. If you think the dollar is going to be weak in the long term, then you need to think differently about commodities and gold.
So
Not just gold, but commodities as well.
right. I'm just trying to pattern match here. And is the idea that you suppress the value of real things so that the artificial value of the dollar stays high? Is that the idea behind these things?
Well,
Does
the
that make sense?
idea, it's political pressure. Americans don't like going to the pump and seeing that it's 25% more expensive than it used to be. An electorate would take a lot of bad stuff, but when they feel like they're getting an economic hit, then they start thinking, well, something's wrong here. I'm going to vote a different way. And that does seem to be what's happening. And we have obviously these elections in November coming up, so it's politically very sensitive. I mean, already they're doing the usual thing, which is saying the oil companies are gouging everybody and all this kind of someone else's fault. But I think we know why commodity prices are going up, and we'll get to that in a bit too.
Sure. All right. Still continuing.
Here we are.
This is
that's
Iran
exactly it.
war stuff. Yeah.
Exactly. So I mean, they're saying they completely control the Straits of Hormuz, but the line of volume coming out of is clearly not recovering. So there's something wrong with the story. And you can see the price increases since the start of the Iran war, from wheat to palm oil to sulfur. And they've managed to suppress the oil price, but diesel prices, as you can see in jet fuel, heating oil, and European natural gas are exploding. So and every day that goes by that nothing's coming out of the Strait of Hormuz, obviously the pressure builds. So this is a problem. It's a political problem, and one that they're not resolving whatever they like to indicate.
Yay to war. Always a good thing for people, right?
Yeah, and equally, there's an election coming up, and here we got the indicator of what policy conditions. U.S. finance is the easiest to come by since 1990 on that chart. That's everything: liquidity, interest rates, real interest rates, money supply, all those things into a single indicator. And you can see that they have to stimulate with the global financial crisis and COVID and whatnot. But right now, even though we've been above our inflation target for 6 years, with a lot of inflationary pressure still happening, they're not tightening anything at all. You can see, if anything, the fire hose of policy is on, and money supply. We're going to show how that is the case, and so this is a really tough time for Kevin Walsh, the new Fed chairman. Next week, he has to make a policy speech at Jackson Hole. He's going to have to try and reconcile all these things and why he didn't want to raise interest rates in these settings when inflation is out of control. The dollar's going weak. Real interest rates are zero. And he, despite dissent in the Fed board on that interest rate decision, he doesn't want to raise interest rates. So he's going to have some explaining to do.
Fair enough. All right. Debt monetization. Always going
higher. So, yeah, I mean, that sounds like a very formal term, debt monetization. What that really means is printing money to finance the government's debt. It's as simple as that. And that has materially changed this year, and it's going up big time. Now, the important lines here are the green line, and the green line and the blue line. The green line shows the bank, how many treasuries the banks own, and it's just going straight up. Now, what started at the beginning of 2026 is the Fed joined that, and that's going straight up too. So if you were to add those two together, we're breaking into new highs at an accelerating rate. So debt monetization is really taking off in 2026, and that's probably not very reassuring for people who are concerned about long-term inflation. So that is also a factor now, is that this, I don't think they can change this. You've seen, we've already shown that the foreigners are selling their treasuries. So who's going to fill the hole? It's the Federal Reserve, clearly. So debt monetization is exploding to new highs in 2026.
Yeah, it seems like, when was the last time the government actually paid for everything with taxes?
A very long time ago. Very, very long time.
Governments don't seem to like that type of limitation.
Well, yeah, I mean, they have some choices, and there's one choice which is easier than the other two. We'll get to that too.
Okay. And then this is
this is if you want to get into it. I mean, a lot of people are very concerned that there's a fight between China and the US over the reserve currency of the world. And this was a very good discussion from an asset manager in China, who a Westerner. And basically, they're saying, I think, so the two questions the first is, does China really want to have the reserve currency of the world? And the answer is no, they don't. Do they feel, from a risk management purpose, that they might need to have an alternative if things continue to get worse with the dollar? Yes. So they're in no hurry to become, the new reserve currency of the world, whatever that, however people see that. I mean, it's very clear that the world is already choosing to sell dollars and treasuries and buy gold. So, if anything, what's becoming the world's new most favored reserve assets, it's gold. But it goes into all of that dynamic. And if you want to dig deeper, it's a great conversation worth listening to. So that's just that.
I really like this line. Beijing's answer to why trust you is simply don't. Like, it seems like they're very prepared for a world of very low trust. And
Right.
that seems to be what we are headed towards, because what do you trust in this world anymore? Just if you ask the average person what country they trust for anything, I don't know, like, other than real patriots, which are getting further and fewer between. It's increasingly the answer is I don't trust any government for anything or any corporation for anything. And so that's a low trust environment.
Right. And that goes back to the capital rotation event that we've been talking about for 2 years.
Yep.
That is all about trust. And, if trusts go down, people want to own gold because there's nothing between you and your wealth. And, this is timeless reality. So that's another reason why people need to consider gold. So here's just an idea of where treasuries are going. They've broken out. 5% is regarded as a key level because it was the peak before 2008. The credit system couldn't survive particularly well back in 2008 when it went above 5 or around 5. That's the point at which the collapse happened. So it's definitely a very sensitive level, and you can see that triangle. It's broken out to the upside, and so that's just where we are right now.
Gotcha.
And the dollar now, I think, has broken down that line. So you can see how that's a trend line going back to 2012. So this is a very significant level if we see it break down from here. And it doesn't seem like the policymakers are going to support the dollar. They have to make choices. There's another slide on that.
Okay.
In fact, this is that slide. Yeah. So America's debt problem now has 3 exits. You've got 3 choices from a policy perspective. Cut spending.
Okay.
Let yields run up. And Besant this week said, no, we don't want yields to go higher because we're worried about the economy. So what's left? Let the dollar
weaken.
Yeah, I mean, what else are you going to do?
They're certainly not going to cut spending. There's no way.
Right. And, you need the economy to stay appearing strong going into an election in November. So at the margin, do you want yields to go up and put even more pressure on the credit markets, which are already, car loans are worse than they were in 2008? Or do you just let the dollar go down? And that fits in with the reindustrialization of America and all those things. But there isn't a free lunch either.
Yeah.
So
fair enough.
Very clear choice, and it seems the market's saying they've clearly made a choice.
Right.
So this just reinforces that that CAPE ratio, which is the black line.
Oh, sure.
Yeah, just look at the chart. That black line, you can see it's right back at the peak of 2000. And actually household holdings of equities as a total is higher than it ever has been before, and that doesn't count margin debt, leveraged ETFs, and options trading, which are all at peaks we've never seen before. So this is extraordinary levels, and we're going to have to watch the leveraged equity funds and the margin debt. If the margin debt has to be liquid, I would say, something like a 10, maybe 20% correction in the S&P 500 would force selling. When you look at the amount of options, margin debt, and overall allocation that people have, the positions are so vast that there will people who will become forced sellers. If it starts going down, people will suddenly realize, oh my gosh, you can lose money by owning equities. So for the time being, you can see that gray line, that's the interest rates. It's still low. That's why they don't want to raise interest rates. That's why Kevin Walsh must be under significant. Trump's was talking about, oh, we have to cut rates, is what Trump is saying this week. I think it was yesterday or the day before. And so they want to keep them. They don't want to raise rates at 4. It'd be bad for treasuries, bad for all the credit and everything like that. So, but if they don't raise interest rates, what's going to happen to the dollar? So, they're in a very tough dilemma here because they don't want anything to go wrong. And they've got pedal to the metal in every domain. As we discussed, the debt monetization, the money supply, the lower interest rates, the whole kit and caboodle, the deficit spending. I mean, it's everything to the max. So if the oil price goes up, or if inflation starts rising, it's now around 3.5. Inflation starts rising, you'll have negative real interest rates. It's the constellation is getting a little bit worrying. But for the time being, it's pedal to the metal, so you can still make new highs, while they can keep this going. But it's getting fragile, and I think people should realize that it isn't a sure thing that equities go up forever.
Gotcha. Okay. We got AI boom news.
Well, just to get an idea of the scale of this bubble, the AI bubble.
Well, it's bigger than railroads back in the day.
Bigger than railroads, bigger than
Whoa.
canals, electrification, highways. I mean, and by a magnitude.
Right. I mean, the thing that really gets this remarkably, like, just the amount I've been reading about Rockefeller lately. The fact that Rockefeller was in an industry that is still nowhere near rivaling AI seems pretty remarkable.
I mean, it really is, and this is the U.S. bubble, right? And now, the AI is actually losing market share and is less than 50% of global AI, with China coming up. So, with railroads, there was only one railroad and a growing population. So it was, it was a good long-term bet. But is this a good long-term bet? I don't know.
Well,
AI and the two leading companies are still not profitable.
Yeah, it's a big question. All right.
So this is the margin debt that I'm talking about, and you can see that the scale of this margin debt is quite astonishing. So we've just seen it come down. It'll come down very quickly, even on a small correction, but it's managed to hold. But you have to watch this, because at a certain point it'll become an avalanche.
Yeah, I mean, it already looks like it's doing the hockey stick thing.
Yeah, and it's not. This particular one is not even the choice of the people with the margin debt. The brokerage will sell. They reach a certain level, they sell, because they don't want to lose money. They
Right.
don't want to count to go from plus to negative. So
Right.
it won't even be their choice when they sell.
So we have a lot of indicators about what is happening in the US with debt, how everything's allocated, and just the tension continuing to build of how is this going to be managed.
Right.
We are nearing a little over 30 minutes now, and I know you wanted to get to some things about the US Treasury. Shall we just
Well,
trying to remind to keep going?
yeah, I think we're nearly there. We're nearly there. So, so this is U.S. gold reserves as a percent of government debt, and you can see in the Second World War we were at 50%. Today we're at 3%. So,
Right.
if the world is now owns more gold than U.S. Treasuries, and it's shifting very fast in that direction. And in the U.S., we're just not remotely in the ballpark of where we could be. There's a basically nobody's talking about gold allocation. Well, not nobody, but this is extraordinary. The extent to which the gold allocation that people have is being ignored, because I guess there's infatuation with the stock market, and for sure, having a stock allocation is a good idea, but do you want to be at the highest ever valuations ever, at a time when there's a lot of fragility?
Yeah.
I think people really need to think about stocks versus gold at this point.
Good to know. All right, keep going. This is the diesel prices that you were talking about before.
Diesel, they're breaking out to a new high. So we're seeing this in these commodities. It's not just gold and silver going up. Diesel is breaking out, and all our food, construction. There's so much uses diesel prices. So all of those things, the price of all those things is going to go up because diesel is going up.
Reality is coming back with a vengeance.
That's
it
right.
sounds.
That's right. And this is that last one. We're seeing a lot of friction at the U.S. Treasury. I think 4 out of 7 of the leadership team of Besant has left. I think that can easily be established. I know this is a Twitter thing, so
appointees have quit or been pushed out. Yeah.
There's obviously a lot of friction and problems at the U.S. Treasury. I'll just leave it at that. You can follow that up if you're interested. But so there are a lot of problems. There's a lot of pressure on the Treasury at the moment, and frankly, we'll see with the Federal Reserve next week. Kevin Walsh has got to make a speech at Jackson Hole, so. The market will be watching closely.
Right. And so how much, I'm just curious, as a closing note, how much would you lay at the feet of policymakers versus general private investors versus media? Like what do you think the balance of responsibility is here?
Responsibility. Well, policymakers are in the front line. They've made promises and obligations about their conduct. So I think you have to put them first. But anyone supporting this is obviously, as investors, we don't have to. We have choices. We can go anywhere. So we have to make the right judgments for ourselves. I don't think we're to blame for the policy, but we need to think very clearly about the choices that we make and how credible we think policy is, how we're allocated, etc. So I think we have to take responsibility ourselves, and we have to take even more responsibility when we're in an environment where trust in the system is in decline.
Right. All right. Well, thank you for once again helping us make a bit of sense as to what's going on and what the main stories are. This seems to be a time more than ever where it's important to keep apprised of what's happening, because with the amount of tension it feels building and all of these things, when things happen, they're going to happen fast and big.
Yes, absolutely. It's preparation is key. Investment is about being forward-looking, not backward-looking about, oh, stocks have been great for so long, it's always going to be okay. You need to be, that might be the case, but you need to make a dispassionate, objective assessment of the future. Not say, oh, it's gone up before, it'll be all right, and just not think about it. And I think that there's enough things that should make you think about what your allocation currently is for if you're a US investor.
All right. Well, thank you once again. We'll see everyone next week. And if you want to stay up to date, meantime, you can always check out Chris, CBIM on X.com. Thanks once again for all the insight. Bye, everyone, for now.
Cheers.